My name is Harmeet Goindi, and for those of you who don't know me, I've been a resident of Tuckahoe for past 10 years. I'm an engineer by education, and but by profession, I chose finance. But what I really like to do is teach people complex stuff in simple manner, right? Which is why I'm here, and which is why I talked about cryptocurrency in the past, and hopefully Chat GPT in the future. so. As a background, I work in financial industry. I worked in banks. Now I work for a exchange, option and stock exchange, and so this field is something that is very dear to me, and I have spent enough time here to know what is important and what is not, which is what I'm trying to tell you right now in this series of lectures. So the question is, let's start. I'm going to do a little bit of recap of the stuff we covered last time, and then we will talk about the stuff that we didn't cover last time, specifically investments. So the question is, why do we care about personal finance, right? Why do we need to study it? And it's because everyone wants to be financially independent, right? You don't want to depend on anything or anyone for your financial need. You want the freedom to do what you want or not do what you want, which is also known as retirement. And generally, we achieve this financial independence by the time we retire because we have accumulated enough wealth at that time. We have paid off our mortgage. We don't have responsibilities for our kids because hopefully they are in college and doing their job, and that's when we retire. But the idea is that you don't have to wait for when you are 65, 70 to retire. If you can do it earlier, why shouldn't you? Right. And the second thing is, even if you want to wait till retirement, you want to make sure that you have enough money so that you can live off comfortably and then leave some for your kids and next generation. So personal finance is a huge topic, right? And basically, it's just a study of how to make the financial decisions that make sense and are good for you, right? And the most important one are, of course, the income that you generate, the budgeting, the spending, that's for the budgeting, and savings and investments, retirement planning, insurance, about your life and property, and mortgage planning, right? So we covered income and spending and budgeting last time. And today we are going to talk about savings and investments. And I think saving and investment is the most important part of personal finance, because if you can't save and invest, how are you going to have enough money when you need it? How are you going to achieve your personal finance needs, right? So that's what we're going to talk about today. But before we do that, right, I just want to talk about a concept that we touched on last time, and we talked a little bit detail last time. I just want to cover it briefly so that I know that few of you were not here in my last lecture, so this would just give you a brief recap. And that topic is compound interest. Compound interest is the best invention made by mankind, and it's not me who said it; it was Albert Einstein who said that. And let me just cover what it basically is. So you all know that when you put money in the bank, you get interest, right? So let's say interest is 10% right now, and you put in $100 every year, you are going to get $10. You can take the $10 and spend it, right? Buy candy or whatever, right? And that is known as simple interest. Every year you get $10, you take that, you spend it, and at the end of 30 years, you would have $400, right? $100 initially and $10 every year for 30 years, so you have $400. That is simple interest. Now, how compound interest is different is it has one small feature. The feature is that you don't take the money out. So every year, whatever interest you have, you put it back into the bank. So you start with $100, end of year, you have $110, you put it back in the bank. So now you have $110. So now you're going to earn $11 of interest. Put that into the bank, and now you have $121, and so on and so forth. So in the beginning, it really builds up, but very slowly. So if you look at the simple spreadsheet I have, in 10 years time, you'd have made $100 on simple interest. With compound interest, you would have made around $150, right? So the difference is only $50. So you would think, hey, why is it such a big deal? It's a big deal because it really grows as time goes by. So at the end of 10 years, the difference is just $50, right? So that's like 25% difference, not much. But the end of 30 years, the difference is that of $1,200, right? Or 300%, 3 times, right? So this is the power of compound interest. And that is why it is something you should always have in back of your mind whenever you're making decisions, be it buying, investing, or taking out loans, because compound interest also behaves the same way when you have taken loan out, and that hurts you. As Greek philosopher Archimedes once said, right? Give me a firm place to stand and a lever, I can move earth. Compounding is like that lever. Give me a small amount of money and enough time, and I can buy earth. So this is another picture that represents how compound interest grow. As you see, the blue is simple interest and red is compound. So first 10, 15 years, you see there's not much difference, but then you can see that the compound interest, the red part, is much more than the blue part. And another way to drive the point home is this the chart where you see the blue line, which is the simple interest, and compound interest is the red line. And as you can see, the red line is growing at an exponential rate. It's not straight, but it is curved. So if you go way out, in like 30, 40 years, this red line would be touching the sky, right? And the blue line would be almost flat. So this is why compound interest is important and something you should keep in mind. Just a simple example is the purchase of the island of Manhattan. Peter Minuit in 1626, almost 400 years ago, bought the island of Manhattan for $24. And people say that's the best trade that anyone did. And I would beg to differ. I would say that if Peter had put this money in bank or stock market and let it compound, right, it would have probably been a better trade, right? So this is just to recap, this is the equation for calculating compound interest. The PN represents the value at end of n years. N years here is 400 years. P0 represents the initial value, which is $24. So you take, and R is the rate of return. And you just raise it to the power of n, which is the number of years. So you don't have to remember this. You can calculate it online. There are a lot of compound calculators, or you can use Excel. But it's a very simple calculation. And if you put it in, and if you put $24 and keep it at 10% interest for 400 years, you end up with $650,000 trillion. If you keep it up in simple bank account, you end up with $6 trillion. The value of real estate of island of Manhattan right now is $2 trillion. So, it wasn't that good a trade. Investing in bank or stock market would have been much, much, much better trade. So that is the motivation. I want you to remember this, right? In 400 years time, $24 would have become more than the money that exists right now in the world, right? So that is something you should always keep in mind when you're investing, right? So just in a nutshell, this is the equation that you should remember whenever you're investing. Initial principle, you should have as much as you can. And then the rate of returns, should try to find something that has the highest rate of return. And N is the number of years. So keep your investment, keep your money invested for as long as you can. There is no upside of withdrawing early, right? So with that, background, let us talk about the topic that we are here to talk about, which is investments. There are a lot of asset class, a lot of investments you can do, right? And some of the most common ones I have listed here, certificate of deposits or bank accounts, stocks, bonds, real estate, options, and then there is crypto, private equity, venture capital, right? So these are like the normal investment vehicles, financial investments, right? And then there are other investments like baseball cards, stamps, wine, art. People buy art. So there is no limit to the instruments available to you to invest, right? And we won't cover all of them because some of them are very esoteric and they involve the whole new section of a series of lectures. So But what we're going to talk about is stuff that I think are important, then you should know and you should be aware of. And there is some stuff here that I think it is not really something you should invest in, right? They're very risky and they require sophisticated investors. So we will not cover it. We'll touch them briefly, and I'll say don't invest in it, right? So let's just talk about the stuff that makes sense. So again, bringing back the compound interest equation, right? You want, like, your initial amount of money you have is constant, like you have what you have. And the amount of years you have, the number of years you have is also constant. So P0 and N is constant, right? You are going to live till 100, you'll retire at 70. There's nothing you can do there. Maybe a little bit here and there, but not much. But what you can change is the rate of return, right? So clearly, right, what you would want to do is invest in stuff that has the highest rate of return. And the way I have put these instruments is they're in ascending order of the rate of return. So certificate deposits have the least amount of returns, and private equity, venture capital, crypto have the highest amount of return, right? So then, yes, the natural solution would be to invest in venture capital and private equity, and then, become rich. But that is that's not so simple, because we have only talked about returns. What we have not talked about is risk. Every investment comes with certain risk, right? Some investments have low risk. For example, bank accounts have no risk or zero risk because it's backed by FDIC. It's the treasury bonds are backed by US government. So they are the safest, because if there is an issue, a bankruptcy issue, US government can always print more money. So you will be made whole, right? So there is less risk there. Now there are risks. There is interest rate risk, which we will talk about later, but the risks are limited. Stocks have a little bit more risk because companies can go bankrupt and no one will backstop them. But then when you come to crypto and private equity and venture capital, they have a lot more risk than certificate of deposits. The reason is because it's a kind of investment where you only hit you get 1 out of 10 investments that work out. So it is inherently risky, and that is why it's not meant for everyone. In fact, some of the cases you can only invest if you have $1 million in your bank account. So then for this particular series, right, I think the thing, and for this particular audience, the thing that we should concentrate most on is bonds, stocks, real estate, and maybe options. For everything else, better to just give me a call and then we can talk, right? So let's start with something very simple. Let's start with savings account, right? The simplest and the safest investment. You have a savings account. In savings account, you can put your money, buy a certificate of deposit, or get money market fund, right? They're all insured by the US government, FDIC, which is backed by US government. And then if you open many accounts, you can have up to $1 million or $2 million. I don't know what the new limit is. That is safe, right? Untouched. The problem is the returns are very low. You don't get much money. In fact, now at least you're getting 3-4%, but before this recent hike of interest rate, you are getting 0.02% or 0. Almost zero. So that is the downside there. But it has a use, right? And the use is that it is liquid and accessible. If I need money now, at this point, like 7 o'clock in the night, I can go to my bank online or ATM and withdraw money and use it. I cannot sell if I have a house, I cannot sell it at 7 p.m. and get money today. It takes months. Or if I have stocks, the market is closed. I can't sell it today. I'm going to sell it tomorrow. Stock takes 3 years to settle. I'm going to see my money in 3 days' time. Same with bonds, right? So there are issues there. This one is liquid. So if there's an emergency, I can always go and get it, right? So this is a place where you put money for, for something that is immediate, right? So rule of thumb is you put in 6 months worth of spending, your household spending in bank, the rest you invest. And 6 months is because, things can happen. You might have an emergency, so you have a place to get money. The other Other reason why you use this savings account is, let's say, in a year's time, your kid is going to go to college and you need to have money for the fees, right? So, let's say whatever it is, $50,000, you put 50,000 in savings account and you can take it out a year later, right? Something that is needs that are coming, that are immediate, you keep in savings account, right? But, anything that is longer than a year, you don't have to. Any need that's longer than a year, don't keep it in savings account, invest. Right, and generally invest in bonds, which we'll talk. So if you are young, right, and recent college graduate, this account should have less money. As you get old, this account could have a little bit more money. That brings us to the most important asset class for our purpose, and that is stocks, right? So stocks are basically, in a nutshell, ownership of a company. When you buy a stock, what you're doing is you're buying fractional ownership of a company. If you buy all the stocks, you own the company, and you can decide who gets to be CEO or who gets to be board of director and what policies you want the company to follow. Well, actually, you just have to buy 10% these days, and that's good enough for you to make decisions on CEO and stuff. So basically, you're a partner in a company when you buy stocks, and you share in their success, right? If you buy a stock with Apple, as Apple rises, your stock price rises, they give you dividend, you make money as Apple makes money. So, so traditionally what people will do is buy stocks in a single company or two companies, or build up their portfolio and have like 10, 15, 20 companies that they like, right? That's a traditional way of investing. Or you can do is buy a pre-made portfolio of stocks, right? And that people used to do back in the days using mutual fund. Vanguard had total return fund, Fidelity had a fund, the Magellan fund, right? So those mutual funds are something that asset manager in one of these big companies, they choose stocks that they think are going to go up. They buy it, pull it together, and you just buy a fractional share of it. So that was the traditional way of investing back in the days, right? Nowadays, it has moved towards ETF, which is again the same concept as mutual fund, but it is much more liquid. Mutual fund, you could trade once a day, right? ETF, you can trade whenever you want. So these days, if you look online, ETF is a much better way of investing. So the traditional portfolios, right, that people generally buy are the whole market. So S&P 500, for example, is a portfolio made by Standard & Poor. It's a company. It comprises of 500 biggest stocks. You can just buy S&P 500 index or ETF based on that index, which is known as SPY. Dow Jones, you must have heard of it. It's Dow has made a portfolio of 30 stocks, which it thinks are the biggest and most important one, so-called blue chip stock. And you can just buy Dow 30 ETF if you want. Similarly, if you want exposure to a broader set of markets, small companies, you buy what is known as Russell 3000, right? That gives you exposure to the whole US market. But if you can basically go down that path and say, what, I don't want exposure to whole US market. I only want exposure to financial sectors or to technology sectors. And there are ETFs, mutual funds, that belong to that sector. For finance, it's XLF, QQQ for tech, and then they're country based. So you have MSCI indices and ETF that are based on countries like Europe, England, India, China, Asia, BRICS. You must have heard of BRICS, like Brazil, Russia, India, China. So you have ETF based on that. So it all depends on your appetite, risk appetite, where you think you want to invest, where there's going to be growth. You can put money there, right? So the point is, the investment universe is huge. In fact, there are more ETFs and mutual funds than there are stocks. There are about 10,000 stocks, give or take, and they are, I don't know, 20, 30, 40,000 ETFs and mutual funds, because it's easy to like mix and match and make a lot of baskets. And most of them are basically crap. So we'll talk about where you should invest, but most of the things that I just talked about, right, the mutual funds and ETFs that are there, thousands of them, I think almost 99% of them are useless. And so if you don't know them, that's good. Just keep listening, and we will talk about where to invest. So again, why stocks? Why do we like stocks, right? So there's a professor, a very famous professor at NYU, called Ashwath Damodaran. Anyone who does any investing always listens to him. He teaches courses. He's a well-known thought leader. And so he compiled a list of all the main asset classes since 1928. And he saw what their returns was, right? So if you're invested in stocks or treasury bills or bonds or real estate or gold, how would you have fared? And that go to his webpage at NYU, and it's still there. This sheet, and he keeps it updating. So he's been doing it for many years. He updates it every year, right? So in very simple terms, in 1928, if you had invested $100 in the market, right, S&P 500. So we're going to stick to S&P 500 for now. By mid 50s, you would have made $1,000. By 80s, 10,000, 100,000 by end of the century, and 750,000 by end of last year, or by beginning of last year. So in rough terms, $100 becomes $1 million in 100 years. That's how stock market has been for almost 28, 97, 96 years, so almost 100 years. That is the rate of return. And you can see the rate of return here, right? It's basically what it's showing is the average rate of return since 1928 is 8.27% after inflation. This is after inflation. So if you add in inflation, if you don't account for inflation, it's about 11%. That's the return you get on stock market. And note that it is the highest. The next best is corporate bonds, which are at 3.9%. Stock market is twice as much, right? And it compounds. So twice as much over 100 years doesn't mean twice as much. It means multiples, right? So that's why stocks are, very, very important asset class, and they are great. Now, by comparison, right? If you had invested $100 in US Treasury bond, which are the safest, in 1928, they would be worth only 8,500. Corporate bonds, which are the second best after stocks, would be 55,000, right? And real estate is just $5,000. Stocks are $750,000. And no, one thing you should note that, right? Corporate bonds are about half the return of stocks, right? So 8% versus 4%. And yet, $100 invested there is $750,000 for stocks and $55,000 for corporate bonds, right? So it's not half, because compounding really, really makes the difference magnify as time goes past, right? So keep that in mind. What is surprising here is that real estate is the worst performer. And we are using Schiller index for this. So it's not, it's a made up number. So people say real estate is a good investment. It's fine. $100 would have been $5,000, but it's not as good as stocks or corporate bonds. Even gold fared better, right? So, what is the crux here? Crux is stock has 9% real returns, that is accounting for inflation. And if you don't account for inflation, if you just look at raw numbers, it's 12%, right? Manhattan, right? The sale of Manhattan, $24 invested in 400 years ago in stock market would have been worth $650,000 trillion. Well, not really, because stock market is not that big. So I don't know how much that would have been worth, but theoretically, yes, you would have been a trillionaire, definitely, right? So if you invest $10,000 in stock market, 40 years, it's $1.3 million. And why do I say, why is this last line important? This is important because 40 years is generally our work life. We enter workforce as 25 and we retire at 65. So when we enter, if you put $10,000, the first sign-in bonus into stock market and forget it, it becomes $1.3 million, right? And so that brings us to the strategy that we should be using to make money, right? What is the strategy, right? I mean, all this is nice and good, but how do you convert it into action? And the point that you should take home is just this. This is all you need to do, right? Maximize your 401k contribution. So I think right now it's about $20,000 or $20,500, whatever. Maximize it. So let's just stick to 20,000, right? Because it's that right now. Start when you're 25. Right now, so for some of us, like me, it's a little bit late, but doesn't matter. This applies to all of us who are, who have time left for retirement. Start investing, right? So at 25, you start investing and you retire at 65. How much do you think you will have by the time you retire, right? So $20,000 every year. Well, it's $800,000 if you just keep $20,000 in your mattress and don't put it in a bank account. It's $2.5 million if you put it in a nice money market saving account. But it's $17 million if you invest in stock market. And by stock market, I mean just by SPY, S&P 500. That's all you need to do. You open a 401k account, deduct maximum, and then allocate it to S&P 500 index. And when you retire, you would have $17 million, right? Now, this is not even accounting for the fact that most of the companies, they match the contribution. The lowest I have seen match is 5,000 per year, right? And that's the lowest. I have seen some companies match more. If you take that into account, you are going to retire with $21 million, right? Nothing. You don't have to pick stocks. You don't have to pick bonds. You don't have to do anything. This is the simple strategy, right? So you start investing $20,000 every year, 401k. When you are 65 years old, you retire, right? So you have $17 million, of which you can give $12 million to your family, trust or whatever, because that is the limit of money that you can give as gift without being taxed. So this is tax-free, $12 million, right? The rest, $5 million, you can enjoy. Let's say you live to 100, you'll live, I think $5 million should be enough to last 35 years. So when you die at the age of 100, let's say, the $12 million gift that you gave to your family, if that family had invested it and not spend it, right? If they're invested in stock market, do you know how much that would be worth at the time you're 100? It'll be worth $864 million. And if you had given your family $14 million, right? By the time you're 100, it would be worth $1 billion. So think about it. You can leave $1 billion to your legacy, to your family, by doing nothing but maximizing your 401k contribution. It is really that simple. There's no magic here. But then the question is, why don't we see more of this? Why aren't we doing it? And there are a lot of reasons for it. The biggest reason is that we do not maximize our contribution. I mean, I didn't do it, and I know this whole slide, I'm doing the presentation, I didn't do it. A lot of my friends who are financially literate, they don't do it for whatever reasons, right? Sometimes you need the money. Sometimes you don't believe that government is going to be around when you retire to give you back your 401k, or they'll start taxing it, or whatever the reason is. So there's a contribution hesitation, right? And it shouldn't be, right? So after this lecture, just remember, do not hesitate, contribute. Okay. The second problem is investment choice is limited. Remember when I say invest in broad market? Well, not every 401k plan has good investment choices. I remember when I had a startup, ADP was our payroll processor. They also gave us 401k plan, and the options I had, they were really horrendous, really bad. So I wouldn't have made the returns that I showed you before, right? And the other thing we do is we start selecting stocks. If you think, hey, let me buy Apple or IBM or whatever, right? And you think, you know better. Well, the answer is you do not. Do not choose single stock. Look, stocks will always outperform a single stock will always outperform a market. Apple, for example, was $80, $2 after split in 2008, and now it's 140, right? So clearly it's better than S&P. Or past 2 years, commodities like oil prices, gas prices, they have been doing really well, right? Or before that, tech sector was doing really well. So if you start chasing stocks, right, and which is what people do, you basically, in the end, you end up at a loss because you're not smart enough to time the market, right? Which is why all you need to do is invest in whole broad market index. And if you're looking for a ticker, SPY is all you need to think about. Just invest there and forget it, right? Do not listen to your uncle or your cousin. Do not chase return. That's okay if you're, thinking you're earning less. It's fine. Over 40-year time horizon, trust me, you're going to be better off than your uncle or your your cousin who was chasing the latest trend, whether it be crypto or latest tech stock, right? The other main reason is the high fees, right? So my plan, ADP plan that I told you, 401k plan, and most of the companies that have 401k plans, smaller companies, have the investment choices that have very high fees, expense ratio. So when you're looking at mutual fund or ETF, you have to look at the expense ratio because they manage money. They take in certain percentage of the assets. You want it to be as low as possible. Right now, SPY or Vanguard funds are at 0.03%. That's what you want, 0.03%, right? That's that's not even 3 cents on a dollar. That's like 0.03 cents on a dollar. When I was, when we had a company and we had ADB plan, I was paying 2%. That is not 0.03, but 2% on fees. And that is the difference. That's like $10 million. So instead of $17 million, I will have, even if I followed my strategy, I would only have $7 million, right? So the small fees, this 2% fees is in the end is worth $10 million. So keep that in mind when you're investing. Look at expense ratio of whatever you're buying. Make sure it is the lowest, right? And so the example is you need to put either an ETF like SPY or the Vanguard funds, the Vanguard Total Market Fund, Vanguard All Return Fund, and they have expense ratio of 0.03. So that is the loose rule of thumb, right? Don't trust anyone, not even you, just trust the market. Okay, so, simple. This is the lesson you learn. Invest early, invest in 401k, S&P 500 is the easiest way. So the ticker is SPY. And then low fees. You need to pay less than 0.1%. 0.05% is ideal. And there are options right now. No matter where you are, just look. You want total market return, total market index with low fees. This is it. There is nothing more to it in investing in stock. And if you want, you can leave this stock right now. If this is all you take from it, that's all you need to know, right? So that is the crux of investing yourself. It's simple. Okay, so we have talked about stock, and I'm sure you'll have questions, and I'll answer them after the stock is over. But one thing I also want to cover today is bonds, right? Bonds are the second. Actually, it is much more liquid. It has a lot more traded volume than stock, so it is important. Everything is determined by bond market. You must be hearing about treasury rates and yield curve, and it's all bond market. Stock market is affected by bond market. So we need to know bond, and we need to know what investing in bond is and why it makes sense sometimes, right? So what are bonds? Bonds are the loans that companies or entities like government take. And when they take a loan, they pay you interest, right? So they're just loans. Like when you have a credit card loan, you pay interest. Bonds are loans taken by government and corporations. So government loans are called treasuries, treasury bonds, treasury bills, treasury notes. Municipality loans are called munis, and then normal loan taken by a company like Apple and Facebook are called corporate bonds, right? So the government, the treasuries are the safest because there is no risk, right? So if government borrows 100 from you, they'll pay you interest on it, whatever the interest rate is when you bought the bond. And at end of the maturity, it's a 10-year bond, let's say. So after 10 years, you're going to get back face value, right? There is no risk because even if government has a lot of debt, they can always print more money, right? So because printing dollars is also in the hand of the government. So this is the safest, right? And then there are corporate bonds, which is issued by companies like Apple, IBM, right? So they have risk. The risk there is that they cannot print money, right? So if they have issues, they will go bankrupt and you're not going to get your money back. And there have been a lot of bankruptcies. Enron, WorldCom are the big ones, Sbarro, 7-Eleven, and smaller companies, they always default, right? So every year there are lots of defaults. So there is that issue. So you have bankruptcy issues, right? And so the corporate bonds, right, are divided into many categories, but broadly two: investment grade, which have low risk, like Apple, for example, and high yield or junk, which was called junk, which is something that has a very high probability of default. And because they have high probability of default, they give you much better interest rate, like 15-20% is what you get. But it is a high chance that you will lose all your money. So let's just stay away from the corporate bonds, right? Let's just stick to treasury bond. Before I go a little bit further, I just want to tell you how the bond market works. It's not very important, but let's just talk about it. So bonds are issued at par. So let's say today, US government will come every day, every Friday, I think, I forget which day, but they come and they issue bonds, right? So let's say you buy a 10-year bond from US government. You pay $100, give them loan $100, you get a bond. And bond right now, the interest rate for 10-year treasury is 4%. So it'll come with a 4% coupon. So you keep the bond with you. Every year you'll get $4, right? End of 10 years, you get back $100 from the government, right? So that $100 is called the face value or the par value, and coupons is the interest that you get. The government bond, US government bond, are from 1 day to 30 years. I don't think 30 years are still issued, but they keep on changing. Face value is 100 or 1,000 or 10,000 depending on where you're buying it. And then there is the coupon that are paying, right? Now, there are two concepts in bond that are important. One is the coupon, the amount of money you get from the bond, and other is the yield to maturity, right? And they are generally, when the government issues the bond, they are the same, but with time it changes. So for example, the interest rate was 0.5% in 2017. Now it's at 5%, right? So if you had bought bond in 2017, you would be getting 50 cents coupon. Now you're getting $5 coupon, right? So that bond that was paying 50-cent coupon is not as lucrative as a bond that's paying $5 coupon, right? So the bond price goes down, which is why, you can see in the slide, it says $85. And it goes down such that to you, the interest that is being paid, it comes back to 4%, right? So that's the difference between yield to maturity and coupon. When you're looking at bond, just look at yield to maturity. It's also known as YTM, right? And there is another type of bond called zero coupon bond. Zero coupon bonds are bonds that don't pay interest, but they sell you at a discount. So if you want to buy a 10-year bond right now from US government, its value is, you pay $60 today, and end of 10 years, you get $100, but you don't get anything in the middle, right? You don't get coupons, right? So they are zero coupon bonds. They're less common. Again, nothing that you should worry about. I don't think anyone here should be buying zero coupon bond, but if you hear it, you know what it means. One last thing on when I covered yield to maturity, right? I just want to point out that bond prices change with interest rate, right? So the higher the interest rate, the lower the bond price. And this chart, right, on the Excel numbers on the right, sort of show you the intuition behind it, right? So in 2019, when the interest rate, 10-year interest rate was 2%, you could issue a $100 loan and pay person for 2%, right? And that's great, right? So its price is $100, 2%, right? But what has happened now? Right now, the interest has gone to 5%, right? So the new bond that is being issued is going to pay you $5 coupon. So your bond that was paying $2 coupon, no one is going to buy it at $100 because I can buy for $100 a bond that pays me $5 every year. So what's going to happen? So for you to sell your bond that pays 2% interest, you have to reduce the price, and you have to reduce the price to $77, right? For it to be equivalent to $100 bond paying 5%, right? That is the risk you have when you're buying bond, because in the interim, like in the end, if you hold on your bond, you're going to get $100 back from the government. But for 10 years, you're only going to get 2% yield. And someone like me who buys it right now is going to get 5% yield. So your bond is not as good as a new bond that's issued because the rates have moved. So if you want to sell it, you have to sell at a loss. Or you can keep it on your book, you can hold it and get $100 in the end. It's up to you. But in any case, you're losing out, right? That is the risk you have with bond. It's the interest rate risk, not the default risk. You're going to get your money back, but the coupons are going to be bad, right? So this is the risk with bonds, even with the safest treasury bonds. And this is the example, right? It's backed by US government, it's risk-free. But if you had bought a bond in 2020, right, it would be down 23%, as you saw here, right? 77. So if you were to trade it, buy and sell, you would have lost money, right? So it's not the best thing out there to buy. Note that in 1920, coming back to that Ashwath Damodaran's piece, if you're invested $100 in bonds, treasury bonds in 1928, it would be worth only 8,500 as opposed to stocks, which are worth 750,000, right? So again, stocks are better than bonds. So why would you invest in bonds, right? So you will invest in bonds for, again, the same reason. It's short term, right? If you have a defined need in less than 10 years, let's say in 2 years time, you have a wedding and you want to spend destination wedding and you want to spend $200,000 there. Well, buy a 2-year treasury bond, right? You get 3% interest rate, price goes up and down. You don't care. At the end of 2 years, you want to get your money back and then, and earn the coupon. So that is where it makes good sense, right? Also note that rates right now for bonds are really good. If you look at, people talk about treasury yield curve, and right now, you can 2 years is around 4-5%, right? In fact, last year, the I bonds, the inflation adjusted bonds issued by US government were giving 9%, which is almost same as stock market. So this is a good time to buy bonds because rates are rising. And then when rates go down, as you saw earlier, as the rates go down, the price, as the rates go up, the price decreases, but as the rates goes down, the price increases. So if the rate go back to 1% in like 4-5 years time, your bond could be 115. So, this is not a bad time to buy bonds, but again, just stick to stocks, right? And just touching on corporate bonds. So corporate bonds are backed by corporations. So they also have the credit. They also have the interest rate risk that we talked about, but they also have credit risk, right? Company can go bankrupt. So again, they are down 21% this year. So this is not a great investment, but they're better than they're better than treasury bonds. So $100 invested in 1928 is $55,000 for corporate bonds and $750,000 for stock. So stick to stocks. So traditional wisdom was that people should invest 60% in stocks, 40 in bonds, or 70-30, right? Or 100 minus the 8 should be in stock. And the reason was that there was a low correlation, which meant that when stocks go up, bonds go down. And technically that was true. If you look at 2008 crisis or stock or dot-com burst, right, and boom, what happens is when stock market is going high, the US government treasury wants to, the Feds want to, reduce the inflation, and they start doing quantitative tightening, which is increasing interest rates. So, stocks goes down, bonds go up, right? So that's how it used to be. But in this market crash, as we have seen, right, it's because of inflation. So not only is the stock tanking, but also the bond market is going up because the Feds are increasing interest rate, right? So generally when stocks are going down, crashing, the US government, the Feds decrease the rate, but this time they are increasing the rate to fight inflation. So for past 2-3 years, all the asset classes, including stocks and bonds, are down 20%, right? So it's, that I think that thing has been debunked. And also if you look at the date, like any 10 years performance, stocks have never been negative except in 2008. So they are safe. But I would say that as you are getting older towards retirement, so till like 50, 55, put almost 90% in stock. But as you're getting towards retirement, right, start taking 2% out from stocks and put it into bonds, government bonds, so that by the time you are 70, right, you have 40% in stocks and 60 in bonds, right? So you have to, as you're retiring, try to change the allocation. But it's okay to keep a majority of it in stocks. So when you retire, make sure, your 40-30% should be in stocks, the rest in bonds. Again, depends on if you're talking about $23 million, then no. But if you don't have that much money, then, you can readjust it. Of course, be mindful of the market conditions. So if you're in a long bull cycle, right, make sure you take out a lot of money from stock and put it in bonds because it's a cycle. And right now it's a bear market. So maybe keep it in stocks for a little bit longer and take it out in 2-3 years time. Again, so this is the few pointers, right, that if you're below 40, or, if you're below 40, maximize a 401k and allocate it all to stock. Between 40 to 50, you can do 80-20 split. 50 to 60 is 60-40, and then, at retirement time, it's 30-70 split, 30 to stock, 70 to bond, right? And always use low fees ETF mutual fund. And Vanguard has a lot of them. If you are stuck, just look at Vanguard and this website that's here. It's ETFDB. I'll post the link and to Swadesh and she can post it to you. Just go there, look at the cheapest ETF list and just invest in them. Right? Now, once you retire though, right? So you need to then be a little bit more mindful of how you manage your money. And that is something known as duration matching. So you figure out your needs for 1, 2, 3, 4, whatever, 20 years in time, 30 years out, and buy those bonds. So buy let's say your need is $40,000 a year, buy a 1 year $40,000 bond, buy a 2 year $40,000 bond, buy a 3 year $40,000 bond. By bond, I mean treasury bond. And so it's, up to 10 years, right? So you know that you're getting a income stream. And beyond 10 years, if you can invest in stocks. So, I've said it 20 years to be very, very conservative, but I would do 20 years, 10 years, and the rest in stock, right? The other thing that you need to know is, up to $12 million you can gift for free. And if you invest carefully, you can have a lot more money than that, and that you can gift to your whoever you want to make a trust, right? So keep that in mind. Okay, so we have talked about stocks and bonds. So one thing that people always talk about is what about options and crypto and real estate, private equity. Look, everyone here, I think, has a house, right? So that is your real estate investment, right? Maybe buy one more if you want to, but buying real estate means headache. You have to manage it properly. You have to make sure you're taking the tax deduction properly. As a return, we have seen it's one of the worst one, right? $100 became just $5,000 in real estate and $750,000 in stock. Having said that, real estate does give you tax write off, right? So that was not calculated in that index. So there is some advantages there, but you have a house. Maybe, don't spend too much more on real estate. Stocks is easy. It's passive. You don't have to do anything. Just set it, forget it, and forget about it for 40 years. And by the time you retire, you're going to should be a millionaire, right? So whenever you're in doubt, just remember this slide. Treasuries, 8,500, corporate bonds, 55,000, real estate, 5,000, stocks, 750,000, right? So this is the key takeaway point. I know we don't have much time, but I do have a couple of slides on retirement. So let me just cover them right here, and then maybe we can go in detail next time. Right. So for retirement, right? Once you retire, what are your major source of income? Well, one is used to be pension, right? So back in the days, big companies would give pension to their employees, GM, Ford Motor, all of them. Now that doesn't happen as much unless you are in government or public sector, right? You don't get pensions in private sector. But what you do get is 401k. So companies open 401k account for you and they match it. Some companies match to 5,000, some go up to 10,000. So there is that. And we have seen, right, just 401k investment in stock market can make you a millionaire, right? So maximize your 401k contribution. I think when you become 55, you can do catch-up matching. So do that. Now, the other source of income is Social Security, right? And I think at this point, the max you can get is $3,600 a month at 67. But if you wait, if you don't start taking it out immediately, you get 8% per year more. So and I think max at 24. So if you wait till you're 70, then you can get about $4,600 a month, right? And that is using current pricing and not counting for inflation. So by the time when you retire, numbers would have gone up, right? So the question is, when should you start taking Social Security out? Well, the way things are currently, if you think you're going to live more than 75 years, then wait till 70. If you think you're not going to live till 75, then start taking out at 67, right? So that is the rule of thumb, the way things are right now. So that is one source of your income, right? And so that's Social Security. So make sure you take that. And but that might not be enough for you, depending on your needs. So then you supplement it with your investments, right? And the way I had said earlier, right? Whatever investment is for next 10, 15 years, just buy those maturity bonds. So buy 1 year bond, 2 year bond, 3 year bond, 4 years, so on and so forth, till 15 years, 10 years, 15, 20 years. And so you know for sure that you're going to get this money back. And the rest you put it in stock market and forget about it. Right. So yeah, duration, that what I just described is called duration matching allocation. Right. And if you have enough, right, then the best way would be to gift it to your family or friend or a trust. Gift now so that your cost basis is low, and then it can grow there if you put it in stock. And as I said, let's say if you give $14 million, when you retire, by the time you're 100, that could become $1 billion, right? So that is something to aspire for. I will certainly try to aspire for that, so that when I'm 100, I'm giving away $1 billion to my kids. But again, as I said, it's not easy. I have been guilty of not following the principles that I have taught in this class.